As most of you guys know right now, the Central Florida market is white hot. There's so many contributing factors that play into that. We've got really high buyer demand. We have historically low interest rates, and there's not a lot of supply that's available. So not as many homes are coming on the market right now. So all of that creates the perfect storm for a white hot market. And I know that I've been talking to sellers, letting them know that, if you have been considering selling and you're looking at considering to sell over the next decade, that right now would definitely be an excellent time to consider selling because of the how hot the market is right now. However, today we're going to be focusing on if you have at all been considering buying a home, you absolutely want to stay tuned for what we have to talk about next. If we haven't met yet, my name is Brandie with the Mathison-Klein Group at Keller Williams Realty, and today I've asked my husband, broker Dave, and my business partner to join us. So Dave, welcome.
Hey, Brandie.
So Dave, I know that we're in a really strong seller's market right now. Today we want to talk more about if someone's considering buying a home, what the benefits and advantages and disadvantages would be if they decide to buy now versus wait. So what are your thoughts on it?
Well, I agree. The market is super hot, Brandie. There's experts out there that are saying it's going to stay hot, and there's other experts that are saying it's not. The truth is, for buyers, it really doesn't matter who's right. If you're considering buying a home, I highly recommend that you do it now, because if you wait, you may be sorry.
So what are the main benefits of somebody waiting now versus, buying now versus waiting?
Well, that's what I kind of wanted to explain today, and actually give a live example of buying a home in a higher priced market at a lower interest rate and how that beats the pants off of waiting and buying a home in maybe a lower price market, but at a higher interest rate.
Okay. All right. And so let's kind of like recap, like what happened in 2020 to bring us to where we're at today.
Well, that's a good idea. Let's start in 2020 because that year started out really good. It started out with a bang, and they were expecting it to be comparable to 2019, but then COVID happened, and our economy basically crashed. Second quarter of 2020, our GDP dropped like 30% or over 30%. I think it was one of the largest drops on record ever since it's been tracked. Now, granted, the third quarter, it rebounded, and the numbers are still out for the fourth quarter. So we really don't know how 2020 is going to end. But during that period, 30 million Americans collected some sort of unemployment benefit, and 22 million of them lost their jobs.
Wow, that is so significant when you really take a look at that. And then on top of that, I know that we've got like 2.7 million homeowners that are in some form of mortgage forbearance right now, which means that they are not able to pay their mortgage.
Right. And think about this stat. Loss of income caused by the lockdown, $300 billion. And something interesting, the feds have been printing and pumping money into the economy like crazy to the tune of like $4.5 trillion.
Wow. That's pretty significant. So like, where does all of that money go?
Well, that's kind of one of the interesting questions. I was reading recently that our U.S. stocks were worth about 38 trillion when the crisis began, and then a year later, they're worth about $51 trillion. So how can stocks be worth like over 30% more in that period, while at the same time those companies they represent had their earnings decline by like 30%? So it's sort of like that money found its way into the capital markets, and there's a belief that a lot of that money has been used by corporate America to basically inflate values, which brings me to my point, and I think should be the biggest concern today for anybody who's waiting to buy a home, and that would be inflation.
Okay, so can you kind of give us a definition of, or like in, layman's terms, like what is inflation?
Well, there's various different, I guess, theories or definitions of inflation, but I guess the one that's most widely accepted would be that there's a faster supply or faster increase of money supply than there is economic output for that money. In other words, it's a supply and demand thing. If there's more money being pumped into circulation, it's going to be used to request more products and services. But if there's no increase in those products and services, then naturally it would cause the prices of those products and services to start going up.
Okay, and I mean, I don't know about you, but I've been seeing prices of food actually starting to increase. I know gas has started to increase as well over the last few months. So basically that's another form of inflation. Am I right in that?
Absolutely. And it kind of works just like, our industry. You have an influx of buyers coming into the market,
Mm-hmm.
but at the same time, there's not an influx of homes being listed, or maybe even in our case, there's a reduction of homes being listed.
Mm-hmm.
What's it going to do to the price of those homes? It's going to push.
It's going to make the homes skyrocket in price.
Right. So basically, if you look at what's happened right now in our economy, it's kind of the same situation. The government's pumping money into the economy. At the same time, our economy has sort of shrunk. It actually shut down for a while. And so, increased money supply, decrease of the production of those products and services.
Right. So how does that relate, the inflation in the economy? How does that relate to someone that's wanting to buy a home?
Well, inflation can affect buyers in various ways. First and foremost, let's look at interest rates. As you probably know, if you've been paying attention, interest rates have been at an all-time low. Like
Yes.
We're talking in the 2s and 3s. And it's allowed home buyers to buy more home for the dollar. But a slight increase in those mortgage interest rates can significantly cut into your buying power.
Mm-hmm.
And that kind of takes us back to the inflation issue. One of the ways the Fed manages inflation is by controlling the prime rate. And so this is the rate that like banks would pay to borrow money from each other short term from their reserves that are kept in the Fed.
Right.
Well, when inflation begins to spike, the Fed will often raise that prime rate in order to kind of slow down the borrowing, slow down the spending, and basically put the brakes on the economy.
Okay. And so do you anticipate that to be the case for this year, or do you anticipate the rates? I mean, from what I've been hearing, they're saying that the rates are going to be staying low this year, but we don't know, right?
Right. Well, I believe if we see a spike in inflation because of the massive amount of money that's being printed and the lack of economic growth, we're likely to see the Fed increase rates, which in turn, I believe will indirectly affect our mortgage rates and cause them to move up. Now, that's my opinion.
Mm-hmm.
Big disclaimer, the Fed has mentioned multiple times that they don't have any plans to raise interest rates in 2021. But I guess the question is, do we take them at their word for that?
Right. So what are some other things that could affect interest rates?
Well, there are multiple other factors, not only related directly to inflation, but also just the mortgage industry itself, the supply and demand. There's multiple reasons that can cause mortgage rates to go up. And honestly, all of those reasons are kind of lining up to potentially happen in 2021. One of those would be if the Fed backs off. You got to understand when a mortgage company writes a mortgage, they're basically going to an investor, and the investor is putting up the money for that mortgage. Well, when the pandemic happened, the Fed jumped in and started buying up a lot of mortgages. There was a period in 2020 where they were actually buying almost 100% of the mortgages that were being written. But now they've started to back off that. So imagine the Fed starts to back off of backing those mortgage securities, they call it. Then now the mortgage companies have to go out to investors to find folks to back these mortgages. Well, when interest rates are super low and the Fed's willing to do it, mortgage companies are happy to write mortgages. But when they have to start going to investors, it's likely that those investors are going to want more of a return. So the mortgage companies will have to kind of push their rates up so that they can make that product amicable to the investors that are backing those. Right. And that's just one way. Another issue is basically just supply and demand in the mortgage industry. Again, if you were looking at our mortgage rates through 2020, there was actually a period where they started to go down at the beginning of the year. And then when the pandemic hit, they actually spiked up for a little bit because there was uncertainty. Right. At the same time, there were huge numbers of people filing or requesting a refinance. And so mortgage companies had to ramp up for that. Right. So they've ramped up for that. They've kind of gotten control of that. And so interest rates have kind of slid back down. But most folks in the industry are predicting that the buyer market will slow down in 2021. And if that happens, again, the mortgage industry is probably going to have to start pushing their rates up to maintain their profitability. Right. So I know that, it's a big unknown as to if the interest rates are going to increase. I know that you had mentioned going through an example of what it would look like if they were to buy now versus wait if interest rates did go up. Can you kind of dive into that a little bit? Sure. Well, let's talk about this first. Okay. Mortgage rates tend to change rather quickly. Like literally they can change overnight. So or several times within a day. Right. So imagine, let's say you're going to get a 30-year note at an interest rate of 2.7%, which I've seen recently, 2.65, 2.7. Average priced home in Central Florida is $272,000. Okay. So at a 2.7% rate, that's about $1,100 a month principal and interest payment. Okay. Interest rates go up to just 3.6%, which is still a great rate. Right. That same $1,100 will now only buy you a $242,000 home. That's a big difference. It is. Like literally, and that could happen in days. Right. So in just a few days, you may have to cut your home buying budget by tens of thousands of dollars. In this particular example I gave you, that'd be a $30,000 difference in the price of the home. Right. So you're either going to have to buy a home that's under your specified standards, or you're going to have to decide to increase what you pay on a monthly payment for your mortgage. That's right. So here's another way that inflation can affect you as a home buyer, and that's in how much your dollar can buy for you, or in other words, how much home your dollar can buy for you. The higher the inflation, the less house you get for the same dollar. When we have inflation, as you mentioned before, items like necessities and luxuries, they can cost more as inflation rises. Right. So when you're paying more for your groceries, for your car, for gas, utilities, you have less remaining for your mortgage payment. And mortgage lenders are continuously adjusting their credit approval criteria based on current economic conditions. Right. Like as far as like your debt to income ratios and all of that other kind of stuff, right? Exactly. Right. So that kind of brings me to my main point. If you're waiting to get into the home buying market once prices seem to drop in the future. Here's the reality. We don't know if or when the market, the market is going to drop.
Right.
It may not even drop in 2021. We're in a very unique market here in Central Florida. There's actually a lot of economists that are predicting the market to actually go up this year. Matter of fact, I believe I saw Zillow was predicting like a 10% increase in home values for Central Florida over this next year. But even if they're wrong, even if values do taper off, or maybe if they even drop, like maybe you're hoping they do, that downturn will probably not happen overnight.
Right.
It's likely to be a longer, stretched out process, maybe over years or months. On the other hand, interest rates could likely go up, and they probably will pretty quickly, especially
like overnight.
when inflation becomes a thing.
Right.
And all the ingredients are there. And when they do, it could happen suddenly. And as we mentioned, only a slight change in interest rates could massively impact your buying power.
So what advice would you give to somebody that's sitting on the fence today? They're contemplating, hey, I've been thinking about buying a house. I know that also right now in Central Florida, rental prices are at a premium. And in a lot of cases, a buyer could actually purchase a home and be paying less when owning versus renting. Would you agree?
Absolutely.
So what other final suggestions would you give for someone that's maybe on the fence, trying to decide whether or not it's the right time for them to buy?
My advice would be, if they're on the fence, get off the fence. Call an agent, call the Mathison-Klein group, and let us connect you with a lender who can give you an idea of what it would look like to buy right now. Because right now we do know what it looks like. We don't know what the future holds. Nobody has a crystal ball.
Right.
But what looks like is happening is that the stars are aligning for interest rates to go up. And if that happens, it could literally be the difference between you being able to be in the market right now and buy a home or not. And if it's okay with you, I'd like to give you an example of what I had talked about at the beginning.
Sure, absolutely.
So imagine you're looking at a $350,000 home. Today's interest rate, 2.7%. So that is a monthly principal and interest payment of $1,420.
Okay.
So pretend like you wait and it pays off. That same home somehow drops in value by, let's say, 8%.
Okay.
So now that home that was $350,000 is now $322,000. That's like over what, $25,000 drop in value.
Right.
However, imagine also, because of the things we've been talking about, inflation, interest rates creep up to 4%.
Okay.
Which still isn't that low, isn't that high. I mean, that's still a great rate.
Right.
And it's not really out of the question. If you think about it, interest rates were in the high fours in 2018 and 19, and they were in the high threes just last year.
Right.
So imagine they go up to 4%. Well, now that less expensive home would actually now be a higher payment every month. It would be like another $120 a month for the next 30 years than if you had bought a higher priced home at the lower interest.
At the lower interest rate. And another thing too, on top of that, is not only would you be paying more on a monthly basis, so your actual overall expenses of what you're paying for the house is more, even though the purchase price was less, right?
Absolutely.
The other thing that I'm thinking of is, let's say that somebody's renting right now, and let's say they're renting something for $1,300 or $1,400 a month. We know what a premium rentals are at right now. So if someone's renting, their rent could easily go up. Their landlord could say, you know what, we're increasing your rent $50, $100 more a month. And that might be that tipping point of what you could afford versus not afford, versus if you're able to go ahead and go out and purchase a home, maybe save some money or pay the same exact amount, and you know that that is a secure amount that you're going to be paying over the next 15 to 30 years, depending on what kind of loan you get, right? So you're having more of a security. Everybody has to have a place to lay their head at night. So you're either owning or renting, or possibly staying with, you know, friends or family. But if you are renting or versus owning, it kind of locks in the security of what you're going to be paying over the long run.
Exactly. It's always less expensive to own than rent. And let's talk about rental, Brandie. What happens to rental prices when the economy starts to shift downward?
Well, the rental prices continue to go up.
That's right. Why? Because there's more demand for rentals. Whenever the housing market went down in the mid 2000s, what did the rent prices do?
They skyrocketed, which
Skyrocketed.
is another thing that we could easily see happen right now because of the 2.7 million people that are in forbearance, in conjunction with all of the people that have lost their jobs, right? There's going to be a large portion of people that are going to need to sell their house, and they're not going to be able to turn around and purchase something. They're going to be forced to rent something, which is going to make the rental rates continue to increase even more, because there's going to be a supply and demand issue with rentals out there.
Bullseye. So that's my message today. If you think the market is too high today and possibly ripe for a downturn, and you're still financially better off buying a home today at a lower interest rate than you are betting the farm that somehow values will drastically drop this year, and at the same time interest rates won't go up.
Right. Well, Dave, I want to thank you so much for your time today and your expertise.
Thank you for having me.
Some of this stuff can be a little bit hard to grasp and understand, and you put it in a much better way than I would be able to. So I appreciate that. And guys, thank you so much for joining us today. Would like to encourage you guys to subscribe to our channel. We put on new videos every Thursday. And also make sure that you check out our buyer's playlist. It gives you all of the details about buying a home and the best next steps. So be sure to reach out to us, and you guys have a great week.